You know, when we think of a disaster, our minds usually jump to one big thing, right? An earthquake, a hurricane, a tsunami. But what if that's, well, a totally outdated way of looking at the world? What if the real threats we're facing aren't just single events anymore, but this tangled up web of crises that are all connected? Okay, let's get into it, because how we answer that question, it changes everything about how we get ready and how we recover.
So let's go back in time. The day is December 26th, 2004, the day after Christmas. For millions of people all around the Indian Ocean, it was starting out like any other Sunday. But deep, deep down on the ocean floor, right off the coast of Indonesia, the planet was about to unleash something terrifying. A massive 9.15 magnitude earthquake, one of the most powerful we've ever recorded, was about to set off an absolute catastrophe.
And what happened next was a series of colossal waves that just shot out across the entire ocean, slamming into the coastlines of 12 different countries. This picture, wow, it really gives you a sense of the sheer human cost. This wasn't just about buildings getting knocked down. It was about lives, families, entire communities being shattered across a vast region, all from one single horrifying event.
So let's dig a little deeper into the impact of what we could call a traditional mega disaster. And maybe more importantly, how the world tried to pick up the pieces.
This number, it's just staggering. It's almost hard to wrap your head around it. Over 225,000 people were killed, and another 1.7 million were suddenly homeless. This was a humanitarian crisis on a scale that very few people had ever seen before, and it kicked off an equally massive global response.
And wow, did the world respond. A totally unprecedented $13.6 billion was pledged to help rebuild. And you can see here, the money came from everywhere. Governments, regular private citizens, big financial institutions, everybody pitched in. It was an amazing show of global solidarity. But, as it turns out, money is only part of the recovery puzzle.
Because all that money ran headfirst into a massive bottleneck. And this slide really shows the central problem with traditional disaster recovery. Just look at the numbers for Indonesia, which was hit the hardest. A full year later, out of 141,000 homes that were completely destroyed, fewer than 5,000 had actually been rebuilt. So even with billions of dollars in aid, the actual on-the-ground work of assessing all the damage, clearing away the debris, and then rebuilding is just painfully slow.
So that slow, methodical recovery was for a single, huge event back in 2004. But the world of risk, man, it has changed so much since then. That old model of recovery is just completely unprepared for what we're dealing with now, something folks are calling the modern polycrisis.
This quote from Jeanette Semelier, it just nails it. The threats we're facing today, from climate change to cyber attacks, they're not in their own separate boxes anymore. Nope, they're all tangled up, and they actually make each other worse.
So, what in the world is a polycrisis? Well, it's basically when a bunch of different crises all crash into each other at the same time, setting off a chain reaction where the total damage is way bigger than any one of those things would have caused by itself. It's not 1 + 1 = 2. It's more like 1 + 1 = 5 or 10.
To make this feel a bit more real, just picture this scenario. A massive hurricane barrels into an island nation. It doesn't just knock out the power lines and flood the roads. In our super-connected world, it also takes down the digital infrastructure, the very systems that run the banks, the hospitals, the government services, at the exact moment when people need them the most. That's the new reality of risk.
So if our disasters are now these compounding, cascading messes, how on earth are we supposed to prepare for them financially? I mean, how do you even begin to insure against a crisis that hits you from 3 different directions all at once?
And this leads us to a really big question. That slow, step-by-step recovery process we saw back in 2004, it feels dangerously out of date in a world of these fast-moving polycrises. It seems pretty obvious that if the problems themselves are evolving, then our solutions have to evolve right along with them. We need a new kind of tool. And that new tool might just be something called parametric insurance. Now, it's not brand new, as you can see from this timeline. It actually started back in the late 90s to help out farmers, but it's been evolving. And fast. It's gone from these regional disaster pools in 2007 to a really sophisticated global tool today designed for exactly the kind of complex risks we're talking about.
Okay, so what is this stuff and what makes it so different? Let's break down how it actually works.
All right, here's the secret sauce. Unlike your normal insurance that pays you back for your specific, proven damages, a process that can take months, sometimes even years, Parametric insurance pays out a fixed amount of cash the second a specific measurable event happens. The trigger isn't how badly your stuff got wrecked. The trigger is the disaster itself.
And the process is, well, it's beautiful in its simplicity. You agree on a contract with a really specific trigger, let's say a Category 4 hurricane passing within 50 miles. The moment the event happens and reliable data confirms that trigger has been hit, boom, the payout is made. It's automatic. No claims adjusters, no mountains of paperwork, no waiting.
Let's use an analogy to make this super clear. Think of it this way. Traditional insurance is all about your house. It pays you to fix the windows that got broken or the hole in your roof. Parametric insurance, it's all about the storm. It pays you simply because the storm was bad enough to cause that kind of damage in the first place, giving you cash in your hand right away to start putting things back together.
Now, this sounds pretty revolutionary, doesn't it? And in a lot of ways, it really is. But it's so important to understand that this is a very specific tool with its own pros and cons. It's not some magic cure-all.
The biggest benefit, hands down, is speed. While traditional insurance is still bogged down assessing the actual losses, a parametric policy can get money into people's hands in days, sometimes even hours. And that quick injection of cash, it can literally be the difference between a community bouncing back quickly or collapsing completely.
But here's the catch. There's a big trade-off, and it has a name: basis risk. So what happens if the hurricane triggers the payout, but your particular house was miraculously okay? Well, you get a payout for a loss you didn't really have. But here's the more painful flip side. What if your house gets completely flattened, but the storm's official wind speed was just 1 mile per hour shy of the trigger? You've suffered a huge loss, and you get nothing. That mismatch is the key risk you have to deal with.
And there are other challenges, too. I mean, these products can be kind of complicated for people to understand. They also totally depend on having super high-quality, trustworthy data to measure the event. And, of course, there's always the risk that someone could try to manipulate that data. So yeah, it's a powerful tool, but it's got to be designed and regulated very, very carefully.
Which kind of brings us full circle, back to where we started. We're living in a world of these cascading, interconnected crises. The old ways of doing things are just too slow for the speed of the problems we're facing. Now, tools like parametric insurance, they're not perfect, but they represent a really necessary step forward in how we think. And it leaves us with this final thought. In the face of this modern polycrisis, maybe the biggest risk of all isn't another disaster, but just standing still and failing to adapt.